We all stumble into mistakes in our lives, from the occasional reply all blunder to more significant slip-ups. But when it comes to investments, the consequences of these errors can be substantial, potentially costing you hundreds or even thousands of dollars. Some missteps are glaringly obvious, while others quietly accumulate damage over time, making them harder to rectify. In this video, we'll uncover 15 of the most significant investment blunders you should steer clear of. Avoiding these pitfalls is the key to securing your financial future. So, stay tuned to learn how to safeguard your investments and your wealth. Don't forget to subscribe and hit the like button to join us on this journey to financial success. Number 1. Only buying companies you know. As investors, we often have this natural inclination to buy stocks of companies we're already familiar with. It's like a subconscious test we put these new stocks through. Do I recognize the company's name? And that's how we end up with stocks like General Electric, Apple, Netflix, Tesla, Google, and many more known companies in our portfolios. These are the household names, the giants we see and hear about all the time. But here's the kicker. There are over 6,500 stocks available on the US market. Yep, that's a lot. And when you stick to what you know, you're essentially shrinking your investing world from thousands of options down to just a handful or maybe a few hundred. The problem is, this limited focus can really dent your long-term investment gains. Why? Because some of the best performing stocks are those hidden gems that most people haven't even heard of. So ask yourself this: am I holding onto the stocks in my current portfolio because they're genuinely the best places for my money? Or is it just because I'm already familiar with them? Sure, it's easy to go for the big, well-known names that everyone talks about, but sometimes the real winners are those lesser-known, maybe less exciting companies that can make the best investments. The takeaway? Keep an open mind. Give equal consideration to the stocks you're familiar with and those that are brand new to you. Who knows? Your next great investment might be in a company you've never even heard of before. Number 2, forgetting to reinvest dividends. Handling dividend payments is a crucial aspect of managing your investment strategy, especially when you're dealing with dividend-paying stocks. Here's the deal. You need a clear plan for those dividends. Some investors choose to have their dividends deposited as cash in their portfolio. That's perfectly okay, as long as you actively reinvest that dividend cash regularly. You see, the stock market tends to trend upward over time. When you leave dividend payments sitting in cash instead of investing them, you're essentially missing out on potential gains. That could come back to haunt you down the line. Alternatively, you can opt for a DRIP, which stands for Dividend Reinvestment Plan. Many brokerages offer this feature. With a DRIP, your dividends are automatically used to buy partial shares of the stock that issued them. This means your dividends never accumulate as cash. They're immediately reinvested in the company that paid them. A DRIP plan makes it easier to reinvest your dividends, and it allows you to consistently buy more shares of the stock at various prices. However, there's a potential risk in the long term. As you keep reinvesting dividends, the size of your dividend-paying positions can grow substantially, and they might become too large compared to the rest of your portfolio. The solution is simple. Rebalance your portfolio. When it comes to handling dividends, either approach is fine. You can accept dividend payments as cash and then regularly invest that cash in new stocks. Alternatively, you can opt for a DRIP plan for automatic reinvestment. Just ensure that your dividend cash is actively working for you in the market. After all, dividends are a key component of your investment returns, so make them count. Number 3, buying companies you like. It's a common pitfall for investors to buy stocks of companies they actually like. It's almost like a temptation. We assume that if we love a company's products or services, it must be a fantastic investment, right? Well, not always. Take the example of someone who owns a Tesla car and adores driving it. It's only natural for them to think, hey, Tesla's got an amazing product, I should buy Tesla stock. But here's the deal. A company is so much more than just the product it sells. And when you take a closer look at Tesla's stock, you might find that there are better places to invest your money. The big takeaway here is not to confuse great products with great stocks. Sure, many great stocks are linked to terrific products, but it doesn't work the other way around. Not all fantastic products are sold by great companies. So, next time you're eyeing a stock, try looking at it through this lens. Is this a great company, rather than just focusing on whether they have a great product? It's a subtle shift in perspective, but it can make a world of difference in your investment decisions. Number 4, buying buzzworthy companies. Here's another classic mistake that investors often make when choosing stocks: jumping straight onto the hype train with the most exciting and buzzworthy companies. You know, those story stocks like Tesla, Netflix, Facebook, and even Beyond Meat. They can be incredibly enticing, and yes, they can indeed turn out to be fantastic investments. But here's the catch. Many of these buzzworthy companies are often overvalued, and they ride the roller coaster of high volatility. Before you fill up your portfolio with all the sizzle and excitement, it's a smart move to adopt a research-based investing strategy. That strategy will be your guiding light when it comes to making purchase decisions. It's like they say, don't let the dazzle blind you to the fundamentals. Do your homework, crunch those numbers, and make informed choices in the world of investing. Your future self will thank you for it. Number 5, owning too few stocks. Diversification is a key principle in investing, and there's solid research backing the idea that owning between 10 to 30 stocks is the sweet spot. This range ensures that your portfolio isn't overly concentrated in just a few positions. You see, some investors make the mistake of putting all their eggs in just a handful of baskets, and that highly concentrates their risk. Even the most successful investors only get it right 50% to 70% of the time. So, it's crucial to spread your bets and not rely on just a few stocks that could turn out to be losers. Research suggests that a minimum of 10 to 15 stocks is needed for proper diversification. Having 30 or more stocks can become quite a handful to research and manage, especially for most investors. Here's the takeaway. Consider owning between 10 to 30 stocks for each investment strategy you're pursuing. For instance, if you're into dividend stocks in one account and high-growth small-cap stocks in another, you could go for 12 dividend stocks in the first account and 10 small caps in the second. But don't fall into the trap of putting all your money into just 5 stocks. That's a recipe for poor long-term performance. Diversification is your friend in the world of investing. Number 6, forgetting to rebalance. Forgetting to rebalance your portfolio can be a costly mistake in the world of investing. As we've discussed, owning between 10 to 30 stocks in your portfolio is essential for proper diversification. But it's not just about the number of stocks. It's also about how the money is spread across them. If you have 10 stocks but 90% of your money concentrated in just one of them, you're not truly diversified. Over time, the balance of your portfolio can shift. The winners tend to get bigger and the losers get smaller, which can throw your investment balance out of whack. For instance, picture this scenario. You initially invest equally in 10 stocks, but in the first month, one of them skyrockets while the others decline. Now 25% of your money is concentrated in that one winning stock. This is when you should consider rebalancing. Rebalancing means adjusting your positions by buying or selling so that they become more evenly balanced. In the example above, you might think about trimming the winning position back to 10% of your portfolio. If your portfolio balance shifts too much, your returns could become overly influenced by the 1 or 2 stocks that now hold most of your money. So always keep an eye on your portfolio balance. It's a crucial aspect of achieving steady, long-term returns. Balancing your investments is like maintaining your financial ship to sail smoothly through the market's ups and downs. Number 7, performance chasing. Performance chasing is a habit that some investors fall into, and it's a behavior where investment decisions are made based on recent performance. This often involves buying into mutual funds or stocks that have recently shown strong market-beating gains. Conversely, it can also lead to investors selling off investments that have recently underperformed. However, making investment decisions primarily based on recent performance isn't a sound strategy. In fact, It's one of the main reasons why investors tend to buy high by pouring money into investments that are already doing well and sell low by abandoning investments that are performing poorly. A more powerful approach is to seek to understand why something has been performing in a particular way rather than simply assuming it will continue on that trajectory. This way, you can make more informed and well-thought-out investment decisions rather than chasing past performance, which can often be a recipe for disappointment in the long run. Number 8, trying to time the market. Timing the market is a tricky endeavor, and many investors who attempt it often miss out on significant gains. For the majority of investors, I wouldn't advise trying to jump in and out of stocks based on short-term forecasts. It's a game that's tough to win consistently. Instead, a more solid approach is to invest in the best stocks and constantly be on the lookout for better alternatives. The key is to build a diversified, long-term portfolio that aligns with your financial goals and risk tolerance. However, there's one exception to the rule, and that's related to avoiding recessions based on forecasting economic data. When done correctly, investors can spot signs of impending economic slowdowns and adjust their investment strategy accordingly. In such cases, it's not about market timing. It's about adapting your portfolio to navigate economic cycles more effectively. But even this is a challenging task, and it's often best done with the guidance of a financial advisor or by thoroughly understanding economic indicators and trends. Number 9, looking at your investment portfolio too much. Active investing is a solid approach, and it involves key practices like rebalancing your portfolio, reinvesting dividends, and ensuring you hold the best possible stocks for your investment strategy. However, there's a fine line to walk when it comes to monitoring your investments. While staying actively engaged is wise, it's equally important not to overdo it. Checking your portfolio too frequently, especially obsessing over daily or hourly changes in value, can lead to emotional reactions. You see, constantly watching every little up and down in your portfolio can activate the emotional part of your brain. It stirs up excitement during gains and disappointment during losses. Unfortunately, when emotions around money are in the driver's seat, it becomes challenging to make rational, level-headed decisions that will benefit you in the long term. So, the key is to strike a balance. Stay active and engaged with your portfolio, but avoid hyper-focusing on short-term returns. Remember, investing is a long-term game, and it's essential to keep your sights on your ultimate financial goals. It's about the marathon, not the sprint. Number 10, watching too much CNBC. Watching financial news channels like CNBC can be informative, but it's crucial to approach them with a critical eye. These channels often aim to capture your attention and emotions to boost viewership rather than provide precise guidance for your investments. Many of the pundits and experts you see on these shows aren't necessarily focused on accurately predicting market moves or assessing the true potential of stocks. Their primary goal is to exude confidence, evoke emotions, and keep you engaged in their shows. It's wise to stay informed about the markets, the economy, and your investments, but you're spot on. Don't get too caught up in the daily excitement created by these talking heads. Use financial media as a source of information and multiple perspectives, but always complement it with your own research and a rational, long-term approach to your investments. Number 11, craving action. Many investors have a natural urge for action, wanting to see their stocks and profits rise quickly. And when things seem to be taking too long, the impatience can drive them to sell and search for something that appears more promising. While there are certainly valid reasons to abandon a position and switch to a better opportunity, it's crucial to ensure that your trading decisions are driven by a well-thought-out strategy, rather than impatience or the desire for constant action. Successful investing often involves a mix of patience and discipline, where you stick to your investment strategy and don't let emotions dictate your choices. Number 12, abandoning a good strategy too quickly. Good investment strategies indeed require patience to fully play out. Many well-researched and proven strategies have a track record of delivering excellent profits over time, but they're not quick fixes. All sound strategies experience periods of both strong and weak performance, Eventually, they tend to outperform the market and generate substantial returns for investors. However, along the way, impatience can lead many to abandon a strategy prematurely. Take value investing, for example. Identifying undervalued stocks or industries often means going against the current Wall Street trends, and it can take a considerable amount of time for the market to catch on. It's a common mistake for investors to give up on a solid strategy just because it appears to be taking too long. What often unfolds is that the strategy finally starts to work, and the investor regrets abandoning it too soon. As we discussed earlier, the market operates on its terms, and our best approach is to aim to profit from strategies that have a strong track record over the long term. So, if you have a well-researched strategy and own carefully selected stocks, remember the importance of patience. Over time, your patience is likely to be rewarded. Number 13, taking on so much risk. You're not sleeping. If your investment strategy keeps you up at night, it's a sign that you might want to rethink your approach. In the pursuit of quick, substantial profits, some investors take on so much risk that it begins to affect their daily lives. For instance, pouring a significant sum of money into a penny stock just before its earnings announcement, hoping it will skyrocket, is a high-risk, luck-based strategy that's akin to gambling. And gambling isn't typically a reliable method for building wealth in the stock market. If your portfolio is causing you anxiety, it's a clear signal to explore ways to better align it with your risk and reward goals. Maybe you'd feel more at ease by investing in high-dividend stocks, or perhaps blue-chip stocks. Alternatively, consider diversifying your portfolio by owning more positions to reduce the concentration of your money in just a few stocks. The bottom line is, if your investments are causing you sleepless nights, it's a good idea to reevaluate your approach. Your investments should be in sync with your financial goals and risk tolerance, allowing you to sleep soundly while your money works for you. Number 14, getting greedy. That old saying on Wall Street is a timeless piece of wisdom. Bulls make money, bears make money, pigs get slaughtered. It's a concise reminder that both bullish and bearish investors can indeed find success in the stock market over time. However, those who let greed drive their decisions often end up facing significant losses. This saying aligns perfectly with the earlier points we discussed about comprehending the market and making informed choices for the long term. Greed can lead to hasty, irrational decisions that disrupt your investment strategy and ultimately harm your financial well-being. So, the key takeaway here is to avoid letting greed be your guide in the world of investing. Stay focused on your long-term goals, maintain a balanced and well-researched portfolio, and remember that patience and discipline often lead to success, not excessive greed. Number 15, blindly following a buy and hold strategy. The buy and hold strategy is often misunderstood and may not be suitable in all cases. It's important to clarify that the essence of this strategy isn't about buying something and holding it indefinitely. It's about making investment decisions based on owning the best stocks for your portfolio. Simply buying and holding a stock forever can indeed be an oversimplified approach that might hinder your long-term returns. Instead, your decision to hold or sell should be guided by the quality and performance of your stocks. If they continue to be the best fit companies for your investment strategy, by all means, hold on to them. However, if their performance or fundamentals change, or if better opportunities arise, it's wise to consider replacing them with something more promising. In essence, the key is to be dynamic and adaptable in your approach, with a focus on always aiming to own the best stocks for your financial goals. Thanks for watching. Don't forget to like, share, and subscribe so you don't miss an upload and you can enjoy the excellent content I send your way.